Lowe's just reported they beat big on both earnings per share and revenue. But look at this, guys. They're down almost 2% during the day. Welcome to the Everything Money 24/7 channel, where we do earnings releases, we do economic news reactions, we do all sort of reactions. If that is something that you enjoy to see what's going on in the market, subscribe to the channel and make sure you mark the notifications. You will love this. Mo, what did Lowe's report? What was expected?
Earnings per share estimate of $2.95. They came in at $3.06. Estimated revenue, $21.14 billion. Reported, 21.36.
Wow. Okay. Beat both.
Yeah. In this environment of where the consumer is.
Now, guys, Lowe's all-time high, 263, 2.5 years ago. Back in December of 2021. The stock has not seen that high. It has a decent dividend here of 2%, which eats up only $2.5 billion of their $6 to $7 billion in free cash flow. Now, one thing I do like, 5-year free cash flow average is $6.65 billion versus 6.5 on the net income. So that's solid. Great gross margin, 33%. Bottom line, last year, a little bit higher than the 5-year average, 9% versus 7.5%. Look at this return on invested capital.
Wow.
Guys, this means that the company gets a really high return on the money that's invested in the business. This is moat status stuff. This means that if they're able to buy back cheap shares, they can really drive a lot of value for investors. Mo, what does the earnings release look like?
So, as we said, total sales for the quarter were $21.4 billion compared to $22.3 billion.
So down.
Prior year quarter. Comparable sales down 4.1%.
So this is a big thing. Comparable store sales down 4.1%. What does this mean, guys? I always talk about this with retail. I look at this saying, these are stores that have been open for a year or longer. It all depends on what company it is. Down 4.1%. Look at a company like Target. They were down as well. Walmart beat. And my indication was going, okay, Target's considered the higher end Walmart. Lowe's is a nicer store. I look at this thinking to myself, is this another indication the consumer is weaker than we think? Again, not trying to be a fudster, not trying to sit there and say, oh, the economy sucks. It doesn't. We have low unemployment. We have growing GDP. We have inflation that's getting more and more tame. But you look at this saying, if people aren't buying houses and they're also not going to Lowe's, what the heck are they doing with their money? Mo, what did Home Depot do?
Home Depot, as a comparison, was down 2.8%.
So both had down comparable store sales.
Now, they did list in here, they said, as the decline in DIY big ticket discretionary spending. That's the big thing. It was offset by the positive in the pro sales and the online sales, but the discretionary spending from DIYers.
So is the consumer weaker than we think? I don't know. But there are a lot of indications. When I see Walmart's same store sales up, where people are going to go to Walmart to save money, and I see Target and Lowe's and Home Depot on discretionary spending going down, makes me think to myself, is the consumer getting a little more apprehensive? Remember, consumer sentiment came out a lot lower than expected just a couple of weeks ago. And remember also that 70% of GDP is consumer spending. So when you have a drop in consumer spending of even 2 or 3%, it can drive down GDP. So Mo, what are they? I know they bought back some shares, and what's their repurchase looking like in the last quarter, as well as what's their outlook for the year?
So during the quarter, the company repurchased about 3 million shares for $743 million and paid out $633 million in dividends. Now going forward, total sales for the year, full year, 84 to 85 billion. Comparable store sales they expect to be down 2 to 3% against the prior year. So going to get a little better compared to this quarter, but still down for the year. Yes. Again, is the consumer pulling back a little bit. Right. So 3 million shares at $740 million. Yep, that's $240 to $250 million per share. Mm-hmm. Okay, that's quite a bit. But you know, you sit here and look at it going, is that a reasonable price? Because the PE is 17, the price of free cash flow is 21. Now the 5-year PE is 20, and the 5-year price of free cash flow also 20. And don't forget, when they buy back those shares, they're saving on that dividend. They don't have to pay the dividends to those shares. So there's a little bit of benefit to that buyback there. But again, is it screaming values? I don't know. Mo, go ahead. And if you're so good at investing in yourself, just keep doing that, right?
Yeah. Well, I mean, Mo, the thing is this marginal? So what Mo's saying is you're getting a high return on the money invested in the business. This is probably driven mostly by decreasing that capital base. So let's check out the 8 pillars on Lowe's. Okay, apart from debt, which a lot of it's probably driven by the fact that they have a lot of leases, it's an 8-pillar company by just eliminating that debt part. I'm not worried about the debt because a lot of it's leases. It's a requirement for the business. It's not like it's a debt offering they gave. It's this debt. Let's see what analyst estimates are saying. Wow, look at this, Mo.
Wow.
Yeah, so stagnant for the next couple of years and then skyrocketing from $13.19 to $19.31 5 years from now. That's pretty solid growth. And revenue, down 11% estimated this year, and then stagnant next year and growing from there, but very minor growth. Very minor growth. Why? Because, it's a pretty mature company, 1,746 stores. How do you really grow that number? That's the question. Now, I had an interesting story that happened to me this weekend. My brother wanted to buy a golf cart. I wanted to buy a golf cart. So he said, Paul, go to Lowe's, check it out. I went to Lowe's. I checked it out. I said to the sales guy, I said, hey, listen, if I want to buy 2 golf carts, will you give me a deal? He goes, no, this is the price. He said it so fast. I laughed going, okay, I respect that. He said it very fast. We buy the golf cart. We didn't buy 2 of them because Mike get to go in. So I leave. We're getting in the car, and we'd been to Tractor Supply already, and we loved that golf cart, but it didn't have a hitch. This one had a hitch. So Lisa and I are driving. Lisa looked at me and goes, Paul, I just like the other one more. I go, so did I. She goes, what about the hitch? I go, we can get one of our guys to put a hitch on there, like manually. She goes, okay, let's just cancel this golf cart at Lowe's and go. I said, sounds good. So we were already on the way home. I got home. I canceled the golf cart. I get a call 5 minutes later. I didn't answer it because I didn't recognize the number. It's the manager from Lowe's in the location. Hey, Paul, they'd asked me on the phone, why are you canceling? I said, and I just basically said I found a better price elsewhere. I did. It was 20% less. I just had to spend the money to get the thing. So he calls and says, hey, I saw you cancel the golf cart you bought this afternoon. I see it was based on price. Give me a call. We might have some movement on that price. And it's funny because I sat there and said, I never called him back, but I wanted to call him back and say, hey, I appreciate you saying that, but it's all the more reason I'm not going to buy it now because I sat there and offered to buy 2 golf carts right then and there if you gave me a discount. The sales guy said no. Now I'm canceling. So now I know in the future, hey, if you want to buy a high ticket item, buy it from Lowe's. They don't give you a discount. Cancel it, return it. Say you found a better price elsewhere. They might call you and negotiate price.
There you go.
There you go. So stock analyzer tool.
Paul just destroyed their sales even more.
Yes, sorry about that, Lowe's. By the way, I love Lowe's. I think it's a great company. And guys, I have to repeat this over and over. If you're new to this channel, I'm really glad that you subscribed, but also we have a fabulous group of insiders in our company, in our community. We built this, we use the tools, we use it to handle the emotions because if Lowe's goes down in price, you got to sit there and focus on the fundamentals and being able to buy when people are scared. That's how you differentiate yourself as an investor. So if you want to be on our inside track, inside team, click the link below, sign up for our community. I guarantee it'll change the way in which you handle your money. Most importantly, the way in which you handle your emotions. So Mo, I did aggressive revenue growth. I think I'm going to tailor this back a little bit. I think I'm going to go 2.5, 4, and 5.5% revenue growth.
Okay.
Profit margin, I don't know why I did so low on this. This must have been a long time ago. I did 5, 6, and 7. I'm going to go with 6, 7, and 8. And same with the free cash flow, 6, 7. I might go actually 6.5, 7.5, and 8.5 on profit margin. And same with free cash flow.
Okay.
Now, PE, I did 16, 19, and 22. And same with price to free cash flow. Can I look at this going, this is not a 15 PE company.
No.
High quality business. I could even justify a higher PE based on their ROIC, things like that.
Yep. And
finally, guys, 9% desired return. This is no margin of safety, just saying, hey, if I want to match the market, this is the price to pay. But remember, if you're going to buy an individual stock, get a higher return. Put a higher number in here when you have our software. Do that because you need that margin of safety. Hit the analyze button. I got prices of 150 on the low side, 300 on the high side, 215 in the middle. I have my stock list watch price at 170 with my margin of safety. Thank you very much for your time.